Dan Knott, welcome to the Frugal Spender Podcast. How are you?
Very well. Thank you very much for having me on.
I know for you now it's a tense time because you're imminently going to have a child. So if you do need to rush out at any point during this episode, let me know.
I will let you know. Hopefully not. Fingers crossed.
So Dan, I've been following you for quite a while, actually. And the reason I like your content in particular, on Instagram in particular, is you focus heavily as a mortgage advisor, obviously on mortgages. And there's not that many accounts really that I've come across that niche down to just mortgages. And I know you do dabble in other things, you do other podcasts, that sort of thing, but I really like that you focus on it. So why don't you give us, all the listeners who potentially don't know you, a bit of a background about yourself and what you do now?
Yeah, so my name's Dan, known online as Dan Does Mortgages. So I'm a mortgage advisor. I do work predominantly in the first-time buyer market, helping people to get to take those first steps onto the ladder. I work with home buyers nationally. The aim is always to make mortgage advice accessible, digestible, hopefully enjoyable. In terms of a background, so I'm from the Northeast, a very typical working class, sort of average background, I would say. I bought my first home in 2018. I used a mortgage advisor. At the time, I was working in finance and had done for many years, but I wasn't a mortgage advisor. And my experience just wasn't as I believe it maybe should be. It was very transactional, a lot of jargon. I felt like my advisor was in the appointment and out of the appointment as quickly as possible, just sort of trying to get the job done, and that was that. And we just didn't have a very good experience. So at that time, I sort of made a plan that was the job I wanted to do. And I felt like things should be a little bit different, and maybe just to do a little bit of a better job. And here we are.
Oh, that's interesting that a bad experience led you to want to kind of improve that experience for the people. That is really interesting. So what is it then? Okay, so I've had a mortgage advisor. I've bought 2 houses in the past, my first house, and then we upgraded to this house. Both times using a mortgage advisor. I wouldn't say I had a negative or positive experience, but what is it that kind of made you feel like it wasn't a positive experience? I know you said transactional, but like, did it just feel like because it was such a big momentous thing for you guys to buy a house and they didn't kind of share that kind of excitement maybe?
Yeah, so although I had worked in finance for around about 10 years at that point, I didn't really understand the mortgage process fully. What that looked like, what the risks were, what the benefits were, what all of the, what the wording meant within the terms and conditions. And it's quite a daunting process when you buy your first home. It's the biggest financial transaction of your life at that point. So, I feel like you want a little bit of reassurance. You want that element of trust involved. Now, because of what I do online, I do a lot of social media, produce a lot of educational content. A lot of people will follow me for months or years before they actually contact me to buy a home. At that point, there's already some form of relationship in place. They sort of look at me and they choose to work with me because they think maybe I'm a good bloke. They trust me. They're confident that I know what I'm doing. And they choose me to hold their hand through that process. So it's essentially relationship. And that can make the process a lot more comfortable for first-time buyers and therefore a lot more enjoyable because they're not worried about asking questions. They're not worried about the nitty-gritty. I will look after all elements of the process if they would like me to, which may be not only the mortgage, but solicitors, surveyors, personal protection, home insurance, so they can get everything under one roof from a person that they feel like they already know. And I just think that makes it a better experience all round, especially for first-time buyers. Maybe later down the line with home ownership or for property investors, it is a little bit more transactional, whether you're remortgaging or buying another buy-to-let for somebody. But when it's your first home, it is a little bit more personal. And for that reason, I feel like my approach can benefit, the right people.
Definitely. Would you say, I know you focus on first-time buyers, but would you say the people who do come to you to get your help to get a first home, what would you say their general knowledge of mortgages? And obviously you talk to people about their finances because you have to, kind of help them make a judgment whether they can actually afford that mortgage or not. What would you say generally from your experience would be people's knowledge of both mortgages and just general management of personal finance?
I would say pretty low. Pretty low. With mortgages, I would say with mortgages to begin with, generally people don't really know a lot about mortgages, but that's normal. Why would you? You've never had a mortgage before. So for first time buyers, I would say that is the case, but that's what I'm there for. But in other elements of finance, especially with, credit history is a good example. People, how they build debt and manage their debt and look after their debt. There's a real lack of knowledge and awareness, and to be honest, a lot of the time, care around that area. That comes from essentially what is naivety, because a lot of the time it's not a problem until it's a problem. So I would say the knowledge around that is pretty low. I typically say to people that around about 50% of my home buyers have some form of adverse credit. Okay, that could be as small as one missed payment up to something more serious. And of those home buyers with adverse credit, at least 50% don't understand what that adverse credit actually looks like in terms of amounts, the dates they occurred, whether or not they're satisfied. So yes, definitely a lack of awareness.
Yeah. I mean, I obviously doing what I do now, similar to you, create a lot of content online, come into contact with a lot of average people. I don't meet them at a point generally where it's a big decision-making process, like a financial advisor or a mortgage broker like yourself would come across. Obviously, people are there with the same intention, but I meet people and talk to people all the time with a wide range of backgrounds, and the financial literacy is awful in this country, and I think it's worldwide. But I think it almost feels like this system really is complicated on purpose. And I don't think it is, because I don't think it's a big conspiracy theory of people behind closed doors doing that. But I think it is just so complicated that people just don't have the time. Like, this is almost a full-time job for me, learning about money and constantly keeping up with what's changing, how to manage money, all those things. For the average person who works 9 to 5, that just wants to go home and spend some time with their wife and kids, they don't have the time to think about stuff. To have somebody like yourself who can hold their hand through the process, that is something that is really complicated, I think is invaluable.
Yeah, and I think I do a lot of work with I'm not sure if it's the right word, but the financial influencer community online. And I believe I'm one of the first mortgage advisors to sort of work with that community a lot.
You're a finfluencer now.
Yes, to have those collaborations, because one of the benefits of financial influencers is that they are making that financial advice and the financial information, accessible. And people can find it on the phone. It's on Instagram. It's on TikTok. Some of it's better than others, in my experience, but at least it's starting conversations and it's building awareness, and it's having people think, okay, what is a credit report? Do I need to think about that? There's a mortgage advisor online. Do I want to buy home at some point in the future? And if nothing else, it's starting conversations, and I think that's a good start.
Yeah, no, I agree. I think there's loads of shit advice out there, and there's also loads of good advice. And it's like anything with the internet, there's too much information to really, I mean, you can to think about like nutrition and fitness. You could Google anything and get two completely opposing views with evidence on both sides. So even though the internet's a great thing, it also causes a lot of sort of friction between, and also actually it overwhelms people in a lot of ways, because you just don't take any action. But I think in this particular space of money and mortgages, because it's so taboo to talk about normally, the fact that even if somebody's out there giving shit advice, or talking about how to get rich quick, but talks about things like potentially the mortgage process or ISAs and investing, at least it's getting into people's minds and potentially, like you said, talking about and ask themselves some questions. So even the bad advice, I think, has its place.
I agree. I'm all for it. In most cases.
Unless it's really trying to scam people, which
yes. Apart from that,
there's plenty of that out there. So I know, I would say quite little about mortgages, even though I am in the space of money and finfluencing, whatever you want to call it. Influence is an awful word.
Yes. That's why I'm always cautious when I use it. I don't know what people want to be called.
It's weird, because when I used to be in the police, people would say to me, well, what do you do? It's really obvious. I'm in the police. Everyone knows what a policeman does. Whereas now I have to say, before we start recording, I say that I do a lot of podcasting, that sort of thing. So you don't want to say podcaster or podcast producer, because that sounds really pompous. You sound like you think you want to be famous. And then you definitely don't want to say influencer.
Yeah. I'll stick with mortgage advisor for now.
Yeah. Good idea. So I know very little about mortgages. So And I'd imagine a lot of people who are listening probably know enough if they bought the first house, second house, whatever. They know enough they know that essentially a mortgage is a loan. But I would imagine most people know that. What do you think from kind of beginning to end through the process? Would you mind just talking people through kind of the basics, like from somebody who first comes to you, knows nothing about a mortgage? What do you kind of explain to them to make it really kind of obvious to them what it is they're doing? And then you don't have to go into super detail, but kind of beginning to end, what would you kind of say are the key points that people should know about?
Yeah, so I would say it's never too early to start having a conversation or to start planning towards buying a home. If you're maybe in your early 20s and you're thinking about buying a home in the next few years, or even your late 20s or 30s, whatever it may be, it's never too early to start building that awareness. So I would always say you need to have, as a first step, an awareness that at some point you are going to need a deposit to buy a home. So even if you're years away, have some sort of plan in place. When am I going to start saving? How much am I going to start? How much do I need to start saving? How much am I going to put away each month for me to be able to buy a home when the time is right? Because there's nothing worse than, if it's avoidable, getting to the time when you're ready to buy a home, but you just can't save that deposit fast enough. Okay, so having an awareness that you will need to save a deposit at some point. Now, to touch on that, a lifetime ISA is a fantastic tool for somebody who's looking to buy the first home. That's a savings account for the purpose of either buying your first home or for later life. But for the context of this conversation, for buying your first home, that allows you to contribute £4,000 each year. And the government will make a 25% bonus on top of that, which is essentially free money. Now, if you're buying with a partner, you can both have a lifetime ISA and maximize that contribution. If you can't contribute £4,000 per year, don't worry, you don't have to contribute as much as you can up to that. Now, as a little caveat to that, you can only benefit from a lifetime ISA after 12 months after you've made your first payment into that account, and you can only benefit from a lifetime ISA up to a property purchase price of £450,000. But that's a fantastic tool. As we say, you can open that lifetime ISA, put £1 in, start the ball rolling on it, get the clock ticking. So when you are ready, it's been open for 12 months. So yeah, an awareness about building a deposit is the first thing. As well as that, have a conversation with a mortgage advisor as soon as possible. Understand if you are looking to buy a home in the future, if you are looking to buy a home for a certain amount, what size deposit you might need. Okay, does your income currently, allow that to happen? Do you meet criteria, or does your income need to increase? Will your level of debt allow that to be achieved, or do you need to decrease your level of debt? How does your credit history look? Do we need to improve that at all? Having that conversation early is therefore going to just allow you to align your goals and to start to sort of walk that path moving forward. Lay some solid foundations so you know exactly where you stand and what changes need to be made moving forward. So those two elements can happen long before you're even ready to buy a home. But when you are ready to buy a home, you will need something called a decision in principle. So typically, a decision in principle is a document from a mortgage lender stating that we would consider lending to Brian X amount. Okay, that includes a credit check. Now, if you've worked with an advisor, if I am giving that decision in principle to one of my home buyers, that's because I'm 100% confident they can access that loan amount. Therefore, they can take that away, get out on the house hunt with full confidence in terms of what's achievable. All right. Now, a decision in principle is not property specific. It's just a generic document from a lender. Now, once you're on the house hunt, if you do find a property that you're looking to buy, if you do have an offer accepted, fantastic. At that time, you will come back to your advisor and you'll discuss the specifics of moving forward. So what is your mortgage product going to look like? How much is the monthly payment? What's the interest rate? Are there any fees attached? If you agree on a mortgage product that's been recommended to you, you will then proceed to a full mortgage application.
Scary. I remember when I got to that point, we actually had a house. Our first house that we bought fell through at that stage. We were given a mortgage in principle, and then, from my limited understanding, the house had to get valued by the bank.
Correct.
And they undervalued the property, which subsequently they found out they were incorrect. But because they undervalued it, they declined our mortgage. And obviously at that time, I knew very little about money and personal finance. And my wife was the one who knew more than me. But that was quite a scary time because, again, even though we had a mortgage advisor, it was terrifying because we're thinking, well, that's it. We're done now. We're not, we can't buy a house. And then I think it got revalued again and it was accurate. So I think there's points like that actually, that I don't know how common that is. Is that a common thing?
I would say for my home buyers, I will have one every couple of months. So
okay,
fairly common. It does happen. Yeah.
Okay.
So when you submit a mortgage application, the lender will complete a valuation of the property. That's for their use only. So they want to find out if the property purchase price matches what you've said, therefore they are safe to lend you the money on it. That's the one area of an application that a mortgage advisor can't account for. That's down to the lender. But if you do have a down valuation, as you've mentioned, there are options, such as going to another lender whose valuer might simply have a different opinion.
Yeah.
Okay. So we do have options if that happens.
It's interesting, isn't it? Somebody's subjective opinion. I'm sure there's objective measures, obviously, but at the end of the day, it is a subjective decision, isn't it? They go, actually, I don't, this house is worth 10 grand less than the last person. So what happens the other way then? If it's valued considerably higher I'm assuming this would be to stop people in maybe potentially families selling houses to each other for a ridiculously reduced price.
So if the property is valued at higher by the lender than what you've agreed as the purchase price, no problem. That's absolutely no problem. It won't have any negative impact on the application whatsoever.
Oh, really?
You've mentioned family members selling to family members at a discounted amount. So that is something that you can do. So that's not an issue. So generally, so it's not an issue at all. So it's actually quite common. So typically from a family member or a landlord, sometimes they may sell you a property at a discount. And with some lenders, that discount can actually be used towards your deposit. With some lenders on some occasions. So no, it's not an issue at all. In fact, as an applicant, it's only going to help.
That's interesting. I always thought the government would adversely look at that as a way to stop people from dodging potential inheritance tax.
No. So in terms of the mortgage application, no, it's only a good thing.
There you go. That's not advised to sell your house to your family, is it? Because it might be something that we are not aware of. Okay, so we mentioned earlier about affordability, and that's one that my wife, at the time, girlfriend, we bought a house, talked about quite a lot. I am very risk adverse to debt now. Back then, I never really had much of a consideration. But the advice that my wife always got from her grandparents and parents, and I think it came from the boomer generation, where house prices were guaranteed to increase because they always did, and to an extent still do. That was the most of that wealth in that generation was generated through property. So the sort of general consensus was you borrow as much as you possibly can, literally find a house that's at the top of your borrowing ability, because over time, inflation is going to erode the debt that you have in the form of that mortgage anyway, but also you're going to get an appreciating asset that over time is likely to hold the majority of wealth. What are your thoughts on maxing out your borrowing ability?
So the answer is different for everybody, and that is the common theme in mortgage advice. So generally speaking, mortgage lenders will lend up to a maximum of around about 4.5 times the income on the application. It will come down from that, depending on debts, children, credit history, things like that. Okay. Some lenders will go above 4.5 times, especially if if it's a higher income household. But yeah, most lenders 4.5 times. On some occasions, we can go higher if suitable. But that's the important part, if suitable. When we talk about affordability, what somebody's actually looking at when they're buying a home is the monthly mortgage payment. However, the higher loan amount will cause a higher monthly mortgage payment. So we need to make sure that's affordable for people. Now, everybody's finances are different. So even if somebody has the same income as another applicant, how much I would advise that they borrow and the monthly mortgage payment that I would deem affordable may be different. depending on committed expenditure that they've got, such as debts, for example, or even non-committed expenditure. Some people may, want to still go on the holidays every year and spend all of the money on that, or they might have quite a social life, or they might have certain hobbies that are expensive. Other people might be a little bit more conservative with the finances and therefore can afford a higher monthly payment. I would generally advise people to be conservative when buying their first home. When buying your first home, the last thing you want is for that to become a major stress in your life. If you can't afford it, you should consider, why do you actually want the home? Do you have to, keep up with the Joneses in every case? What is it that you actually want from your home? But what I would say is when we are talking about, borrowing at our maximum capacity, according to lenders' affordability calculators, in some cases, it may be more suitable due to maybe a predictable increase in income. So maybe if you're working for the police, over the next so many years, your income is going to increase by so much. Then a couple of years later, it might increase again, and then it may be increase again. So if you know that those changes are coming, that may influence, your mortgage, what we feel comfortable with. As well as that, if somebody is self-employed and they've got a growing business and we are confident that their income is going to continue to increase in coming years, again, that's a consideration. Okay, but generally I would say to be conservative, because you don't want to, push your finances too far to the point where owning a home becomes a problem.
Yeah, definitely. So it's interesting. Do you obviously you have all these conversations, people work out affordability and intentions of buying a house and stuff. Is there often times when you feel people are actually doing it to keep up with the Joneses? Is that a common thing?
Yes. Yeah, in some cases, yes. Sometimes people will arrive and they, maybe their goals are unfortunately too big for where they are currently. Maybe because they literally cannot access the mortgage that they would ideally want, and it's not possible, or maybe it's just not advisable. Looking at how they've maybe managed the finances in recent years already. But yes, sometimes people do come to me and they want to buy a certain house in a certain area, and maybe that's not achievable. And we do need to have a conversation of maybe you can't afford that, but you can afford this. Is that something that's realistic? Is that something that is realistic? What would that look like for you? Is it moving to a different area? Is it moving from a 4-bed to a 3-bed, or a 3-bed to a 2-bed? What does that look like? Is that feasible? And yeah, that's a conversation that we have all of the time.
I guess you're in quite a privileged position, really, where you kind of get a peek into people's sort of lives behind closed doors in a way, because finances are so private, especially in this country. People tend to keep it very, very quiet what's happening, and quite often people are in worse situations than they like to outwardly show people. So, yeah, it is quite a privilege to see, I guess, behind closed doors, the reality of people's lives financially.
Yeah, and I think when I've mentioned about being online and people already having that trust and relationship, people can sort of see where my intentions lie as an advisor. It is all in your best interests. You can see, people who I've worked with in the past. But yeah, sometimes people will come to me and they'll be a little bit hesitant due to maybe credit history. And I always tell people, trust me, I have seen everything.
Yeah.
I really have. So, it will never be the worst credit report I've ever seen. So let's have a look. Let's have a conversation about it. Let's see what we can do. If we can't do anything right now, let's have a look at what changes need to be made for you to achieve that goal.
I guess in a way, you're kind of like a money coach as well, aren't you? Because you kind of directing them towards this, even though the ultimate goal in your case would be to help somebody get a mortgage. But at the end of the day, you have to at least evidence, good credit history, but also good management of finances to prove to the lenders that you can afford it. So actually, it's kind of net benefit for those people who get the mortgage. Hopefully, I mean, whether it sticks long term or not, they at least have to, for a short period of time, to evidence it to a bank or a lender that they're good with their money. So hopefully you can guide people, teach them some things, maybe reduce your debt here, maybe do this, maybe do that, and actually that could, over the long term, improve their finances overall. So you are a bit of a money coach in some respects.
Yeah, so one of my knocks online is sometimes I don't like seeing. I think we'll put too much emphasis on credit score tools and credit score apps, and as if there's there's these things that are magically going to boost your credit score. If you just speak to a good advisor who works with credit reports every day, I look at credit reports every day. I can tell you instantly where the problems are and tell you instantly where that leads you in terms of your finances, or what changes need to be made, if any. So yeah, we do, coaching people through that process is something that we do every day, as well as that managing debt. A lot of the time people will come to me and say, Dan, I've got a lot of debt, but I do also have some savings. Should I use those savings to contribute towards the deposit, or should I reduce the debt, or should I do a little bit of both? And navigating that process with people is again a conversation we're having all of the time.
Interesting. I've never really thought about kind of your role as also being quite, very, very coaching in that aspect. Because the advisors I've had previously, maybe, your intentions of getting into the industry in the first place, but I never felt like I was being coached.
So I would say though, if somebody comes to me and everything looks good, the income adds up, they have a low level of debt, the credit history looks good, then there isn't necessarily any coaching. If that's the case, it is a case of, right, let's get everything in. Let's understand what your goals are with your mortgage. And then let's make sure you achieve the best possible mortgage as soon as possible, on time and first time. So it does depend on the individual.
Yeah. So you mentioned earlier about going through the process for self-employed people as well. I'm now self-employed for the last couple of years, and that's something that we are thinking about, my wife and I, because we are wanting to probably in the next year or two potentially look for another property, not a second property, to sell this property and move. We have had kind of conflicting advice from people about what we need to consider from self-employed perspective. What are the main things that for people you work with that are self-employed, what are the main things that you tell them to consider, or early stages, somebody in my position, let's say, what would you say to somebody to think about and maybe get ready if you're self-employed, and for anyone who's listening?
Yeah, so it's always a case of having a conversation with your accountant and letting them know what your goals are with your finances. When we work with an accountant, we're always trying to be as tax efficient as possible. However, when you are applying for a mortgage, that may not always be the best route to take. So we need to understand, for you to buy a property of, £300,000, what does your income need to look like within your company accounts, your tax calculations? What does that income need to look like? And then that's a conversation for you to have with your accountant and within your own business. Is that something we can achieve or not? Can I earn enough money to achieve that goal? And then the ball's in your court. But when you are self-employed, every lender considers your income in a different way. So some lenders will use salary and dividends. Other lenders will use salary and your share of the company net profit if you are a limited company director. So it's my job to have a look at your finances and then advise you how it is we can make best use of those figures. Is it with a lender who uses salary and dividends? Is it with a lender who uses salary and net profit? I will advise on that for you. Now, most lenders, on most occasions, will want to see 2 years tax returns. In most cases, again, as long as that income is increasing, they're going to use an average of the latest 2 years. Now, you may hear that it is possible to get a self-employed mortgage with 1 year's accounts and 1 year's figures, and it absolutely is. Okay, it absolutely is. However, only if it's suitable, and you can access the lenders who are offering that. Okay, but yeah, as an advisor, we will look at all options to make sure you're achieving the best possible mortgage for you, whatever that may be.
Yeah, so it's essentially self-employed people have a privilege in some respect of being tax efficient. One thing that my PAYE friends like to remind me all the time. Some people would say self-employed. Well, the hatred that I get actually through my videos that I do on this subject is that anybody who's self-employed are basically just tax avoiders, which I always find an interesting argument. The argument of being tax efficient, that's always an interesting phrase, tax efficiency. It's the accountant's favorite phrase, tax efficiency. Essentially, pay as little tax as possible, which I guess is a different moral question we probably won't get into today. But
yes,
it's a subject actually that I think about quite regularly, because there's people, the vast majority of people in the UK who don't have a choice about how much tax they pay. And then you have people who can manipulate how much tax they pay to a certain degree. But when it comes to purchasing a house, obviously, many people don't have that option. It is whatever my salary is. And actually, when you're buying a property, you want to artificially increase your income as a self-employed person to make it appear to the lender that you, in fact, have a higher salary than you do, and then potentially even lower it down in the future. So I find that whole process really weird from a self-employed perspective.
So what I would say is, obviously, it all has to be, it all has to be legal, and it all has to be correct.
Of course.
In terms of, your income and the figures that you are declaring. It's more so that, it's not so much sort of increasing your income. It's on other occasions you may sort of decrease your income. Some people, whether they're putting extra certain things through as expenses, for example, I don't know what people are doing with their accountants or what conversations they're having, but you need to have that balance and understanding that sometimes you can't have both if you're looking to buy a home.
Yeah, absolutely. And that's, again, I think from my experience, obviously, you pay yourself as little as possible, which we've always done from a self-employed perspective, simply so that we don't end up paying a huge amount of tax. But it is to the detriment of evidence to a lender. And from somebody who's very anti-debt, it's a bit like a credit score, really. Having to borrow money to then borrow more money, I always find is a weird concept. And in this case would be pay more tax to then borrow more money.
Yeah. And I'm actually quite anti-debt to an extent too. I don't know if you want to get into that.
Absolutely. That's my favorite subject.
So I was brought up to be very cautious financially. My mum sort of made us very cautious. My mum was sort of essentially a worrier when it came to finances growing up. And that's led, to us being sort of quite conservative. Now, I do have a car on finance. However, that was sort of necessary debt because I needed a car and I didn't have the money to buy a car at the time. However, people get confused often because you see online, that debt can be used as a tool, and it absolutely can be for the right person who has who has real and educated intentions behind that debt. However, if you can avoid debt, then surely it can only be a good thing. In terms of you hear a lot, you need debt to build a credit score. That's going to allow you to buy certain things in life or to buy a home. But I actually released a video recently stating that if from 18 years old, all you do is have a level of debt that's proportionate to your income. Okay, so your debt's not out of control. You make your regular payments on time. If that's all you do as an adult, you should have a credit score that's good enough to buy a home. Okay, you don't need a large master plan. You don't need to take out 10 different loans to build your credit score. That's not necessary. Most people will have some form of debt anyway, quite naturally, such as having a car on finance, or maybe at some point they do need to use a credit card. But we don't need to be using debt just for the sake of it, because what can happen is we can start to build bad habits, and bad habits can lead to problems further down the line. So yeah, I think that there are a few myths around debt, but to be clear, if somebody, is using debt as a tool for further investment, or if we're talking about, buy-to-let mortgages, for example, absolutely. But that's intentional and it's educated and there's a purpose behind it.
Yeah. I think for the vast majority of people, debt's not a good thing. I think for the vast, and I think that number might even be in the 90% and above. I think that myth around credit cards is a huge one that I come across all the time, because I have historically created quite a lot of content around credit cards and how people don't need them. The only exception to that would be the protection, the Section 75 protection. From my perspective, I have a credit card in my name for the sole reason that if I go abroad, I need to rent a car, because I've personally been stuck in Canada with my girlfriend at the time, and I only had a debit card, and they would not. We were in the middle of nowhere, and they would not give us a car because I did not have a credit card. So the only reason I own one is for a situation like that, which I think in itself is a crazy concept, that even though I had the money in the debit card to pay for the damages and the insurance premium and a potential, if I did have a crash, whatever their excess was going to be, was all on that account. They could have taken it out of my card. They still refused to do it. So in that perspective, that would be the only time I would say, actually, a credit card for the most people. That is the way to go. But this myth around credit cards and credit scores that you have to have a credit card to have a good credit score and you have to buy things from credit card and pay it off every month it's absolute nonsense. My credit score on Experian is 999, and with the other two reference agencies is very high, and I have zero debt other than my mortgage.
I agree. I think there's an absolutely massive myth around it. I have conversations all the time with people saying, Dan, I've got this credit card debt because I'm looking to build my credit score. But they've got a 15% deposit for a house. So I always say, let me have a look at your credit report. I'll let you know if you need to improve your credit score. Quite often I look at it, I'll say, your credit score is exactly where it needs to be. Now, I'm not your parent. If you do want to keep your credit card, keep it, okay? But you need to know that you don't need that debt in order to buy a home. And you need to know that.
Yeah, it's an excuse for my experience. For a lot of people, it's a safety blanket, and it's an excuse to buy shit that they don't need.
I think there's a huge problem though around, especially with young adults, how accessible debt is now. Like you get a letter through the door every day. You're entitled to this credit card at this interest rate. Online there's so much access to debt. Even to go off topic, sort of, the online gambling and everything that's available through apps. Yeah. Problems are so accessible now, financial problems. And I think that's a problem, especially for young people who, if you're 18 years old, in my experience, what I see is people quite often don't really care if they miss a payment or if they have quite a large bit of credit card debt, because maybe at that time they're not buying a house anytime soon. And they don't really have any major financial goals. And I think that's where problems can begin and then bad habits start.
Yeah, no, absolutely. And I challenge anybody listening to this, the next time you go buy anything, literally anything, to see if there isn't debt that's tried to be forced down your throat, like Klarna, ClearPay, all of these buy now, pay later. You try and buy anything, they're trying to catch you and say, no, you don't need to pay now. You don't need to pay now. Just pay later. And, the young kids in particular are the ones that are going to get bitten. Because I'm very anti-debt and credit cards from the start. It was because of credit card. I got into credit card debt when I was 18, 19. And I didn't really think about it. I knew nothing about it. And I just thought it almost felt like free money. Now, that wasn't even that accessible because I had to apply for the credit card, have an affordability check to a degree, not really, but at least had to kind of ask you what your salary was and just take your word for it. Whereas now, it doesn't really matter who you are, what your credit score is, what your credit history is. You could be in crazy amounts of credit card debt, but you could go to Argos and buy something for £20 and Klarna will be offered to you and you're going to be accepted.
I know people, I'm from the Northeast, as I say, a very typical working class background. I know people who took out a payday loan because they wanted to go on a night out when we were younger. And that's still, that's still shown on the credit report. And that can impact, and people don't realize that can have an impact on you buying your home or whatever it might be. But yeah, it's too accessible. And there's a lack of awareness and a lack of care.
Yeah, absolutely. And to sum this a little bit up, I think, the small percentage of people that can use debts, because there are, people don't become billionaires without using debt. People can become millionaires without using debt. Hands down, I think that is probably the best route to do it. But I think for billionaire status, people need to leverage, take loads of risk, borrow loads of money and take risk. But that is a very small percentage of people that succeed doing that. The vast majority of people that tried that went bankrupt. So it's important to remember that.
And I think online, there's so much talk now about a lot of the financial information online is financial freedom and it's cryptocurrency and it's investing in property and it's, but there's not a lot about the very low level stuff.
Yeah.
Of just ticking your basic boxes and making sure that you don't mess it up in the first place.
Yeah. Like you said earlier, the word, my favorite word with money now is conservative.
Yeah.
And that's a loaded word sort of politically, but I think that is the best way to be with your money. It really is. You take as little risk as you possibly can with your money, and you will not just financially be better off, but mentally. Because I think, I don't know if you've ever been in debt in your life, but having come from being in debt to not being in debt now, just the day-to-day mental stress that being conservative with your money is, just, like having car finance. When we had car finance, I would stress that when I had to get the car serviced, it had to be done at a particular place, and it was going to cost me a certain amount of money. And what if I crash this car? It's not my car. So this kind of element of always having a bit of anxiety in the background, because I know I owe something to somebody else, and I know I am one of the accounts in the sort of finance space that heavily talks about not having debt. And there's not many that do. I think most people are kind of in the middle. Debt's okay if you're using the service space. I'm very much lean towards not having debt, but that's only because I've experienced both, and I can feel even to this day, not having debt, how positive that is on your day-to-day living.
And in a household, I would say, from most people's experience, most stress in a household comes from finances.
Definitely.
Parents growing up, struggling to pay for whatever it might be, money stress. I've just moved house recently. Everything costs a little bit of a refurbishment. Everything costs a little bit more than it was meant to. And financing causes so much stress. So I agree. Minimizing that will give you the best chance of a happy and content 100%. Life.
Yeah. And like you said, the basics are the bit that you need to get right. It doesn't have to be fancy crypto or, buy someone's course to become rich. It really is like basic stuff. Do a budget.
Yeah.
Have as little debt as possible. Learn to invest. Learn about mortgages. These are like basic level stuff that should be taught in schools anyway, but obviously aren't. So it requires people like us to talk about it on podcasts.
Yeah, well, hopefully we're getting there.
So a topic that, speaking of creating content online, one topic that I reckon has always been the most controversial thing that I create content about, and probably has the most engagement, actually. If I look back recently through some old videos that I did, and the ones that have the most comments are always about mortgages, and in particular, the subject of overpaying or not overpaying. So I've done videos of saying you should overpay your mortgage, or should you overpay your mortgage, or should you invest that money instead? Now, a lot of people who are against the overpaying of the mortgage will say, well, I can get a higher return by investing. And those people normally don't invest. So I find that argument quite hilarious. But the subject of whether you should overpay your mortgage or not is one that has so much controversy behind it. What are your thoughts?
My thoughts are, do whatever you would like to do, but I'll tell you why. Because everybody's different again. Now, what we see online is, see a lot of videos of do not overpay your mortgage. You can leverage that money to spend it elsewhere. Absolutely, you can. Okay, you can use that money potentially to invest it in other areas, which will therefore see you build more money in the future. Absolutely. If that's something that you're interested in, if that's something that you're comfortable with, go for it. There can be undeniable benefits. However, most people in reality, or a lot of people in the UK, as British people, we do like to be quite safe. We do like that safety net, whether it's, we're British people go on holiday to the same destination every year because it's safe. We'll go to the same restaurants locally. A lot of people, the goal is just to have a mortgage-free home so that they know as the kids are growing up, they've got a mortgage-free home. They don't need to worry about that, and they are comfortable because that's what they see is comfortable. Now, if that is the case, not a problem at all. And, mortgage overpayments can save you a lot of money on interest. It can see you be mortgage free a lot quicker. And it's a tool that many, many people use. Now, typically, most mortgage lenders will let you overpay by 10% of your balance per year. Okay, without penalty. Now, that's quite a large amount for most people. You can make lump sum payments. You can make monthly payments. There's pros and cons to doing both, depending on your circumstances. But should you or should you not? If it's a goal for you, if your primary goal is to be mortgage free as quickly as possible and not to have to pay for the mortgage every month, mortgage overpayments are a great tool. If you do have interests elsewhere, in terms of investments, not a problem from my end. Again, as long as it's educated, you know where you're putting your money, you know roughly what that return is going to look like, and you're not doing so blindly, or you're not just taking, taking a chance without knowing what's actually going to happen with your money.
You see more people doing that now because the interest rates are so high in comparison to what they were just a few years ago?
I think the average person, I don't think that impacts their decision too much on whether to overpay on the mortgage in terms of interest rates. I think for the average person, I don't think that's necessarily a predominant factor, other than the fact that the mortgage payment is going to be higher anyway, therefore they're going to have less money left to overpay.
Yeah.
But I don't think, in my experience, the average person or looks at interest rates and thinks, so should I overpay now, or because of interest rates, can we place it elsewhere? I think people are just typically in a mindset of either they want to invest or they want to overpay the mortgage. And I think that's in reality is where most people sit.
Yeah. Because realistically, most people's disposable income has taken a massive hit since the cost of living crisis began. And like I said, with the higher interest rates means a higher payment. I mean, I went from, I'm such an idiot. I should have locked in my fixed rate 2.5 years ago. I think I got it at 1.2%. My mortgage was like £400 a month, and it's now over £1,000 a month. It's 5.6, I think. Oh God, that was a hit. That's the most depressing thing. And I should have known. I mean, nobody has a crystal ball. Nobody knows where rates are going to go. But why didn't I fix it for longer?
I think a lot of people feel the same way. I've just came out of a 5-year fix, moved home, and I think my interest rate went from 2.28% up to, I believe it's 5 point something, in the low fives. So yeah, I've had the same problem as everybody else.
Yeah, it's depressing when you're paying literally the same amount of money for the exact same thing, and most of it, well, if not all of it's going to interest pretty much. And that's why I totally agree with most people probably aren't thinking about the decision with interest rates. But for people who are listening, thinking, why would you do that? Would be because it's guaranteed return on your money. Essentially, you're not obviously getting the money back. It's been locked up in an asset that's not liquid, i.e. your house. But for me and you, we're going to get, if we were to overpay our mortgage now, we're going to get a guaranteed 5% return essentially on our money. Which means paying off our mortgage quicker, which means paying less interest in the future. So there's a few benefits as to why I like the idea of overpaying your mortgage. And I'll finish this point and then I like the idea of the Dave Ramsey approach to things of overpaying your mortgage. If getting all your things in order, like saying the basics, being conservative with your money, invest through your pension, do all those good things, all those boring things that people tell you to do throughout your life, but nobody actually listens, things that we talk about. Do all those things. And once you've done that, then overpay as much as you can in your mortgage. Don't not have a life as a result of that. Obviously, depending on what your income is, can you afford it? This isn't even a thought process for somebody who's struggling month to month, obviously. But if you're at a point where you've got disposable income, I am a huge fan of overpaying your mortgage simply because of that piece. I've never been mortgage free, so I don't know what that's like. But I would imagine it feels pretty bloody good being in a house that you have, for me now, would be over £1,000 a month extra pay and knowing that I own the property that I'm in.
Yeah, and I'm a big fan of, your financial decisions. There should always sort of be an intention behind it. So if you look online, there's Martin Lewis has a good one, an overpayment calculator where you can put in, if I overpay by £100 per month for the next 10 years, how much does that save you on interest? And when will you be mortgage free? And if you just use a little tool like that, you can then sort of look and say, right, if I do make this £50 overpayment, that might have me mortgage free by 55. As an example. And again, I think that's a good place to start.
Yeah, that's a good point. And I would hate to know how many hours over the last few years I've spent on those calculators, both mortgage overpayment calculators, but also compound interest calculators. They're a great way to dream and it's not setting in stone, I want to be mortgage free in exactly 6 years and 1 month and 2 days. It doesn't just, even though that's what it will tell you, but just having this kind of broad idea in your head of what could possibly be in the future if I were to make those little minor decisions like overpaying your mortgage by an extra £50, something that, if the rate went up slightly, that was going to happen without you making that conscious decision or not. Actually making that conscious decision might really minimize the term of which you have with your mortgage.
Yeah, absolutely. And you can make either monthly overpayments or make a lump sum. It's completely up to you. If you are a little cautious about doing it at first, you can set up a regular monthly payment with your lender, of which you can cancel at any time. That means that, if you've got a certain amount of money in your bank, you may not want to put that all as an overpayment immediately, because once you've done so, you can't just get it back straight back out. So you can set that up as a monthly payment. And then if further down the line you want to make any adjustments to that, or you even want to, stop them for any reason, maybe the car breaks down, you've got the flexibility to do that. But lenders are great with this. So have a chat with your lender, understand what your allowance is, and go for it.
Do you think lenders like overpayments? Because ultimately they're getting less money in interest, aren't they?
Do I think lenders like overpayments? I don't think yes, because they let you overpay by quite a bit, really. 10% of your mortgage balance is quite a lot. If somebody has a mortgage balance of £150,000 and you can overpay by £15,000 per year, that's a lot of money. So they do give you a lot of leeway with it. The terms and conditions may differ slightly from lender to lender, but typically 10% of your balance per year. So yeah, lenders are great with it, to be fair to them for once.
Yeah. I mean, I suppose the vast majority, 99%, I would imagine, aren't going to be able to pay any more than 10% of their, annual balance anyway. So I guess they kind of just go, people can't do it. So yeah, let's let them do 10%.
Yeah, definitely 99.9% probably can't. I'm going to be overpaying by that 10%. But if anybody does want to do that, there is an early repayment charge typically attached to a fixed rate at that point, and the early repayment charge will apply to the amount you're overpaying over your allowance only.
Well, hopefully at that point you're paying off your mortgage because you won the lottery, so that that fee doesn't matter anyway.
Fingers crossed.
Yeah. Speaking of sort of interest rates, and obviously nobody has a crystal ball, and this is not absolutely set in stone. But what are from your kind of experience in your day-to-day life, and obviously having to follow interest rates and dealing with banks all the time, where do you see interest rates going in the near future?
So over 2022 and 2023, interest rates shot up, as we all know. Then in the final quarter of 2023, interest rates sort of quite consistently began to come down for the remainder of last year. Then at the start of this year, there was a little drop again in interest rates across the board generally, which was good to see. But I would say since the end of January, interest rates have plateaued. Some lenders will put the rates up, some lenders will put the rates down, but it's little changes most often. So I feel like, I do believe in terms of mortgage interest rates, where we are now, I do think we'll be there for, the next few months at least. After that, due to how many different factors can impact the economy and interest rates, we can't say. But I would say over the next few months, I'm not expecting any changes. Some lenders may increase the rate slightly. Some lenders may decrease the rate slightly. Or lenders may do a little bit of both. But yeah, I would say where we are now is where we will be over the next few months, in my opinion.
Yeah, it's a bit like the stock market in a way, isn't it? You're always just trying to predict what's going to happen, what's going to be released, what's the Bank of England going to say, all of these things that obviously you can spend your life analyzing, and you're still going to get it wrong. But that influencing a decision, like it did with me, of taking a 2-year fixed rate at a low interest rate and not a further one, because I thought, well, interest rates are always going to be low because they have done historically and artificially low, because back in the 70s and 80s they were hell of a lot higher. So of course it's going to continue to do what it's doing. Now I was wrong, and now I'm paying more than double for my mortgage. But I always find it fascinating in the UK that we have such short fixed rate periods in comparison to the US, and how I don't know, you'd know more about this than me, but for most people I speak to, it's usually a 2-year fixed that people take because they don't know what's going to happen. You can't look further than 2 years. Maybe it's a 5-year, like you did, with a more educated guess, or maybe you're going to stay in the same house for longer. But as far as I'm aware, I've never heard of anyone taking a longer than 5-year fixed. Do they even exist, for a start? But also, I know in the US, you can get your entire mortgage on a fixed rate, up to 30 plus years, which seems really alien to the UK.
Yes, so it is pretty much alien to the UK. So most people will typically either go for a 2 or a 5-year fix. Some lenders do offer a 3-year fix. There are options with some lenders for a 10-year fix. But even with that, I work primarily with first-time buyers. So generally younger people. Fixing for 10 years isn't suitable for most of those first-time buyers. Reason being, it's hard to predict what's going to happen over the next 10 years of your life, because that's a long way into the future. And you don't want to get tied in for 10 years and then find out you either, you want to sell your home, you want to move home, you want to refinance the property, and maybe you might incur some early repayment charges. So for most people who I work with, a 10-year fix isn't going to be suitable. And I've never arranged a 10-year fixed term mortgage. Now, you do see, sometimes you'll see headlines, you know, these lenders are considering some form of 30-year mortgage in the UK or whatever it might be. I'm not sure how much of that is a marketing tool. As we've mentioned, it's simply not going to be suitable for most people, because it's hard to predict what's going to happen over the next 2 years of your life, never mind the next 10 years or beyond that. So that's the reason I've never arranged a 10-year fixed term mortgage. For people who are maybe more suitable for 10-year fix, might be somebody who's a little bit older, they're settled into their forever home, that just maybe they've got around about 10 years left on the mortgage. They don't want to have to worry about it again moving forward. They just want to lock in and be done with it. But for most people, that's not going to be suitable.
It's weird culturally, though, that, you know, the mortgage product itself obviously is going to be differences, but at the end of the day, the US and the UK, the mortgage is the same thing, in the sense that you want to buy a house that you can't afford, you're going to take a loan out. It's weird that in the US that people are prepared, and that is commonplace, that is the norm, to get a 15, 30-year fix. And in the UK, we're more skeptical and think, oh, things are going to change in the next couple of years. I find that fascinating.
I think it's just it's a cultural thing, isn't it? You just do what you used to, most people. I think the long fixed term product in the US maybe started in the sort of the Great Depression. I think that's when it sort of became a thing. And yeah, they're still there today. But yeah, it is weird. I'm not too clued up on the US market. I'm not sure how it works. But I don't think it's going to be happening here anytime soon.
No. So with the penalties that people would incur, let's say somebody went for a 5-year fix and then moved after 3 years, can they, I believe the word porting, can they change it from one property to another without incurring costs, or is it always costs if you move? Is that a big consideration?
So there is an option to port your mortgage if you are moving home, if it's suitable. Now,
can you explain what port means? Because I've said that word and I have no idea what it means.
Yeah. So if you have a current mortgage, so I have a mortgage on my property at the moment. Let's imagine I have a good interest rate. Okay. In 2 years' time, if I decide to upsize to a larger property, typically, in theory, I could port that mortgage over. So transfer my current mortgage with my current interest rate and my current terms onto the new property. Okay, so the benefit in theory would be that you're not incurring any early repayment charges and you're preserving your current interest rate if you would like to do that. However, in reality, it's not that straightforward, because typically when people are moving home, they will need a higher loan amount in order to purchase the more expensive property. The problem with that is that that may mean that you have two properties running out of sync. So one fixed term deal might end next year, your other fixed term deal might end a year and a half after that, which means because you've got two mortgages running out of sync, at some point you're either going to have to pay an early repayment charge on one of them, or you're going to have a period spent on the variable rate for one of them in order to access the cheapest deals in the market in the future. So typically, porting most commonly isn't most suitable, because it can end up costing you more in the long term. Okay, so you need to have an awareness of that. But if you don't port your mortgage and you do move home, there may be an early repayment charge. Typically, how early repayment charges work, it's different from every lender and every mortgage depending on the terms, but something like this: on a 5-year fix, in the first year, there may be a 5% penalty on how much you overpay over your allowance. In the second year, that may be 4%, 3%, 2%, and 1% in the last year. So if you redeem your full mortgage because you're moving home and you're getting rid of that full mortgage, you're repaying that full mortgage that you currently have, you'll have your 10% allowance and you'll pay the charge on the remaining 90%.
Interesting. So porting isn't quite as simple as I thought in my head.
Definitely not. So I speak to people all the time who are interested in porting, and an advisor can help you to port your mortgage. But typically, or a lot of the time, you can be better off just paying the early repayment charge and then just starting again. So you've got one mortgage, you don't have two running out of sync, which can potentially restrict your options in 2 years' time, 5 years' time, and beyond.
Yeah, interesting. Okay, so Dan, my final question for you is one, again, that I come across all the time on social media, creating content about money. I don't know if you get this into the comment section, which is awful places on social media generally, but from younger people who are just like, they just don't think they could ever be able to own their own property. They just feel like it leans usually towards the political discussion, but because certain parties, and that's not a discussion I want to get into with you, but like, is in like, the government has made it so difficult through minimum wage and all that sort of thing, and just kind of generationally, boomers and even millennials potentially had it easier to buy properties, whereas now the younger generation, a lot of them feel like they're just going to rent for the rest of their life. What are your thoughts and experiences from like dealing with younger people, because you deal with a lot of first time buyers? What are your experiences around that?
So yeah, at the moment it is hard. It's maybe hard. It maybe is harder than it's ever been in the past. I believe the average house price now is something like 9 times the average salary, of which is ridiculous. If you go back to the 70s or the 80s, when maybe grandparents or parents, depending on how old you are, may have bought properties, that may be something more like 3.5 times. At the moment, it's around about 9 times, which does make it difficult. It's absolutely not ideal, and young people do have the right to be upset about that. However, can it be done? It absolutely can be done. I work primarily in the first time buying market, and I help people to buy homes every day. Okay, so because it is more difficult, it's more important to be educated. It's more important to have a plan, because maybe we're not going to have as many options as what we might have had, if we bought a home 30 years ago.
Is that seeing products sort of like, leading towards 100% mortgages again? Do you feel like that's kind of where the government are going to lead to? Because I mean, the first house that I bought was through the help to buy scheme, which was super helpful. The government giving you 20% deposit of the value of the house. Are there more and more products like that now that are leaning more towards smaller deposits just to try and help those people?
So there are. So a major mortgage lender released a product in the last few weeks, which is it's been called the 1% deposit mortgage product, or the £5,000 mortgage product. It's exclusively for first-time buyers. Essentially, you can purchase a property worth from £100,000 to £500,000 with a £5,000 deposit.
Good idea.
Okay. Now, is that advisable?
No.
Not in all cases. The pros are a smaller deposit. That's about it. The cons are higher interest rate, higher monthly payment because you've got a higher loan amount. The credit scoring criteria is going to be stricter. As well as that, the major one is a larger risk of negative equity, of which may reduce or impact your options to refinance or move home in the future. So yeah, these sorts of mortgage products, as I alluded to earlier, a lot of the time, I'm not sure how much of it is a marketing technique from lenders, but for most people, they're not going to be suitable. I would always advise, if possible, when buying your first home, save up to at least a 5% deposit as a minimum. That's where we should be starting from.
Yeah. That's what I did for our first house. We had 5% and then 20% from the government. And then, we probably caught the tail end of a bit of luck from parents gave us money as well. And I think that's something that's dwindling over time, because I think people's parents are struggling financially, so even they can't afford it. What would you say is the most common way people get their deposits then, from first time buyer perspective? Is it their own savings, or would you say it's financial help from family?
There is a lot of financial help from family.
Yeah.
That's maybe more common than somebody may think. To be clear, you can be gifted money from a family member. It's very standard. All lenders will accept it. That the gifter just essentially needs to sign a document stating that this is a gift. It's not a loan. They won't be living at the property. They have no financial interest in the property. And it's fairly straightforward from that point. If you do have that option, fantastic. That will help you. But, a lot of people are, I do see a lot of home buyers benefiting from the lifetime ISA, because saving a deposit is so hard at the moment with the cost of living, with the interest rates. If you are in a position to use the lifetime ISA, open one as soon as possible, because it's helping a lot of people.
Is it 40? Is that the age for a lifetime ISA? Is that the oldest the oldest you can be to open one? I think it's 39 and
Oh, sorry.
As in, I think once you turn 40, you can't open a LISA anymore. I think I'll double check, but I'm pretty sure it is.
I believe that's the case. Yes, I thought you said 14 there. So
No,
say 14.
that's quite young. That's quite young. Yeah, as in the general consensus is even if you're 30, like if you're 39, even if you don't need a LISA or don't think you need a LISA, because it's not, it can also be used for retirement as well.
Correct.
Just open one for £1, and if you never use it, fine. But having the option to get that 25% free money, which it essentially is from the government, then you need to do it.
Yeah, absolutely. And the awareness again that you do need to have it open for 12 months from making that first payment. So if you are looking to buy a home next week, don't open a lifetime ISA and put all of your money in. And it's for properties up to £450,000. Now, there's always a conversation about, the fact that amount hasn't changed since the lifetime ISA became an option. Yeah. So people always ask, Dan, will they be putting the £450,000 limit up? Will they be increasing that? If the question was, should they increase it? Yes. Yeah. Will they? They haven't done it yet. But most of my buyers, don't have to worry about that because that's a relatively high amount for most first-time buyers.
Sure. Unless you're in the Southeast, London in particular, that's kind of the pushback that I think Martin Lewis has been campaigning for quite a while, is the penalty that you get if you were to withdraw that money, because you're going to buy property above 450,000, or you need to withdraw the money for whatever reason, you lose that, you lose your 25% bonus from the government. So essentially it was a waste of time if you do that for a few years.
You can lose more than that. So if you put in £1,000 and then you get your 25% bonus, and then there's a 25% withdrawal fee on that, you can actually end up with less money than what you started with.
It's crazy.
So yeah, we do need to be cautious when we are putting money in.
Yeah, absolutely. Dan, I feel like I've learned quite a lot about mortgages in this discussion. Thank you very much for your time. I appreciate it. For anyone who's listening that either wants to use your services or find out more about the content that you create or where to find you, where should they go?
So my main social media page is at @DanDoesMortgages_ on Instagram. It is Dan Does Mortgages on TikTok and Facebook, and on LinkedIn, it is Dan Knott.
Awesome. Dan, thank you very much for your time. Appreciate it.
Thank you very much for having me.